We can be narrow-minded and suggest that the stock markets are doing well. The economy is booming and everything is steady and stable. We can fool ourselves only so long. We get this view by looking not just at US markets, but specifically just a handful of tech stocks. That's it. They're by far the best performers, making up almost all of the gains we have seen in 2018. But no worries, the Fed will bail me out, right? You came here for the truth, so let me unveil that for you. Today we're going to look at emerging markets. I want to cover Europe as well. We're going to go into some charts, some articles, and I want to begin with this article out of the Wall Street Journal. A rout in emerging market assets has sparked concerns that the turbulence could spread from distant corners of the world to the US and elsewhere, fueling a cycle of accelerating risk aversion. A sharp sell-off in Brazilian stocks and its currency late last week fed into a wider retreat that hit emerging market assets from Mexico to South Africa, and it rattled Italy's weakened bond market, something I've been covering here for a little while. Many currencies of developing countries are near multi-year lows despite a boost from strong commodity prices and solid global growth, while investor allocations to emerging market-focused bond funds are at their lowest level of the year. This is the type of issue that is important because you can't just look at FANG stocks and say that's what I'm invested in, therefore everything is fine. There is contagion and there is risk in this system today, more so than we have seen since the financial crisis. That's the level at which we should be prepared in our allocations. The spasms highlight the effect that a stronger dollar and a higher US bond yield can have as they amplify the problems of vulnerable countries threatening assets that investors recently considered to be comparatively safe. The list of repercussions includes everything from increased pressure on economies in Argentina and Turkey, which gorged on cheap debt with interest rates stood near record lows. Think about all of the different countries out there who have been thriving because of record low interest rates. That's practically all of them. But now interest rates have been rising. Will the central banks decide to reverse course? Perhaps, but they haven't done so yet. Falling fast. Stocks in Brazil, Turkey, and Indonesia have tumbled in recent weeks, raising fears that volatility could spread to other markets. So you look at this as of January, things started to decline, but as soon as practically February came in, we had this decline in their particular stock markets. It is showing us the same sort of weakness that we are seeing in the general stock markets of the US as well, and Europe as well. But if you put in, if you were to take out the tech stocks, those handful of FANG stocks and so on, that would show us a completely different picture of what the US stock market looks like. Trending down, a strong dollar has weighted on emerging market currencies for recent months. Same conditions are apparent here: Indonesia, Brazil, and Turkey. Pile up. Record amounts of emerging market debt are set to mature this year and next year. This is a very big concern right now because you could see that it is an excessive amount. We're talking about trillions of dollars that are ready to mature. When they mature, what's going to happen? Are they going to be able to necessarily roll that over into something else? Is it a higher interest rate? Do they have to take more risky bets? Are they able to get buyers? Will the central banks have to monetize? And so on. These are all factors that are never addressed in the mainstream media because they don't want to freak anybody out. Now, this is something that we're going to look at for Europe right here. We're looking at the Target 2 balances, okay? Now, for those who don't know what Target is, Target stands for Trans-European Automated Real-Time Gross Settlement Express Transfer System, okay? So just to get you a better handle of what that is here, you're looking at, I want to focus on these two right down here. And immediately when I saw them dropping to these levels, I had an idea. I thought, Spain and Italy, right? It's got to be Spain and Italy. So I looked at the legend down here, and if my eyes are correct, Spain is red and green is Italy. And so we have a big problem. We have a big problem for these two countries specifically, but it's not just them. Of course, we have a big problem for a lot of these. And the one country here who has been seemingly doing better and better is Germany. As this crisis worsens, it seems that Germany is the one who really stands head over heels. on this in this regard. You know, when other countries are heavily in debt and their economies are suffering, it seems like Germany is taking the opposite side of that. Now, this is just one small thing. I just thought it would be interesting to mention. But look at this. Conscious decoupling of U.S. equities from the rest of the world. This is something that I have shown you many times before, and as time goes on, I will continue to show it. Financial crisis hits, and we saw this big decline in the markets everywhere, okay? Everywhere was declining. It didn't matter that it was subprime housing that started this effect. You know, you had Bear Stearns, you had Lehman Brothers, you had all the mortgage companies, Fannie Mae, Freddie Mac, the lenders were suffering, and then it tumbled into the rest of the world, right? So everything drops. Then, March 2009, we really had that upswing in the markets, okay? For US equities, you could see they've been rising and rising and rising, but the rest of the world has sort of been stagnating, slower growth. And that's interesting. When you look at global equities, excluding the US, it's a completely different picture. But if I zoom in further, I start to get an even more strange picture, because it's not really US equities that have been rising. It's only a handful of stocks, and it is the stocks that the central banks are buying, the institutional investors are buying, and the little fish, the minnows, are following behind. So what we're looking at here is simply a matter of central bank intervention. That's all. That's all it is. Okay, and then last but not least, I wanted to show you this here. Italy, their 6-month bill versus Greece's 6-month bill, and you'll see that Italy's is actually considered to be more risky than Greece. That tells you something. The market has been pricing this in now, that Greece is becoming safer. They've got their bailout. The IMF and the Troika are going to rip apart the country, and that makes the market feel calm and secure. But Italy, we don't know what's going to happen. Are they going to sell the Colosseum off to, you know, Amazon and Starbucks? Have a nice little Starbucks logo on the outside of it? Maybe. Who knows? They're going to have to sell off their assets, though. And until that point happens, until the IMF comes in or the, you know, different supranational entities come in and decide, well, you're going to have to sell off these assets and those assets, and your stock market is going to drop temporarily. And if you had your own currency, that would be dropping significantly. But let's just rip you apart, and then you can be like Greece too, and you could become more safe, even though both of these countries are supposed to be considered high risk at this time. We don't know what's going to happen. But somehow the market gets this idea that if the IMF comes in and steals everything from the country and the people, then suddenly it's safer. Which one should be considered safer? Well, in my opinion, I wouldn't put a penny or a dime into either of these countries right now. It's just not a good time at all. Whether you're looking at emerging markets, whether you're looking at Europe, it is just so risky. There are certain entities, of course, that are going to be bailed out regardless, and there will be, I believe, companies that will outlast countries. That's a fact. But I just look at these and I think to myself how funny it is, the way that the market prices everything in. And tomorrow it could be completely the opposite. It's just complete schizophrenic behavior that the market has, with all the volatility index riding at all the way at the bottom practically. It's a joke. I just wanted to show you this as a little bit of humor for those who have the same kind of humor as me. Another joke to end the video off. If you found this video informative, please give me a thumbs up. When you give me a thumbs up, it helps to support this channel. I do appreciate that very much. And last but not least, if you found this video informative, I know you'll find my books, The Money GPS, and my newer release, Global Economic Collapse, even more informative. You go through school, you don't learn a single thing about finance, about financial education. So that's why I wrote these 2 books. I took everything I've learned and I squeezed it down into 2 books. The book on the right is my first book. I talk about the financial education, the 4 asset classes and how to profit from them. The book on the left, that's my more recent book, and it covers familiar topics, but I also get into tax incentives, reducing your expenses, and more. They don't really deal with the same issues, although they do cover similar topics. It's sort of like puzzle pieces, and one fills in the gaps of the other. So that's something that I know that so many people have learned a lot from, and I hope that if you read these books, that they will bring you the knowledge that you need to survive. That's all. Take care.